Well, gentlemen, surprise move, no change. But do you see the logic in the move? Because the MPC appeared to be saying that they wanted to see the impact of some of the moves of the central bank just prior to this meeting and see how that works out before they make any further moves.
Well, I think that, Harold Wilson said 1 week is a long time in politics. Economics says that 24 hours is a long time in economics. The price of oil, when they made that move, was 53, in fact 55 in January. Today it's 25. It's not the same circumstance. So desperate times call for desperate measures. I think that to the extent that the central bank have the tools to use as, outside the meeting cycle, means that what it's telling us is that they will use those tools appropriately without sending signals, because signals can be misread, especially where economic agents are actually desperate, right? So they will read anything. An adjustment in the value of the currency, which is a good thing, right, could be misread and it could lead to speculative attack. There are shortages, there are all of that. So I think as long as the process of fine-tuning monetary policy to be consistent with monetary conditions, because what it laid out was monetary conditions of a particular level, and monetary policy going counter-cyclical to bring some kind of equilibrium into it, and aligning that with the fiscal thrust. I think that's what it is. What he has said, okay, give us some time, but we are not going to be sitting and waiting for the next meeting. We are going to be doing things in between meetings. So I think that's clearly the message. But I think there's more to come than just, but the bad thing is that the monetary policy rate is an anchor rate, which anchors all other rates. But the central bank governor says that even if we increase it, banks will increase the lending rates. If we reduce it, they will not reduce their lending rates. So to that extent, what's the use of the MPR?
Well, we know that it goes beyond the MPR, so there are other things they can do with the cash reserve ratio. But essentially, when you think about it, the whole point of monetary policy meetings like this is to influence behavior. So either you're making liquidity flow or you're making investors react in a certain way. So at the end of the day, you think about what they can do with their policies right now, given the conditions.
You've got to come back to what is the framework. The framework is explicit inflation targeting. The target is 6 to 9%. You are almost at 13%.
Right.
After 12%, you are growth retarding. But like I said earlier, recession is what kills you. Inflation is what hurts you. But if you are not alive, then inflation becomes academic. So what you are looking at is the specter of a possible global recession and a domestic recession, by which time inflation becomes an academic argument. So I think all of these are going to be weighed out. There are definitely going to be meetings and meetings outside this meeting, and steps and actions taken outside this to ensure that the economy is on an even keel.
Right. Of course, because of the safety measures being put in place, we're unable to hear any questions taken by the central bank governor. But Lanre, surprised by the move, and how do you see this?
Very, very.
How do you analyze this?
Very, very surprised, and I think I think Bismarck has touched on it. Is what's the value of the MPR? It should signal, what rate should be a benchmark rate for lending, but apparently it seems to be quite relevant in the grand scheme of things. Yes, banks might not necessarily follow, but usually there's this moral suasion when that number is announced. People behave in some kind of way around that number. Yep, it's right. I mean, the CBN has other tools around doing it, achieving its objectives in the market. You follow what the T-bills rates are and what the government bonds are going at today. They're down. So he's probably thinking, listen, we've somewhat crashed our borrowing rates, and banks should probably, benchmark off those numbers. But he's been quite an activist. I mean, he definitely comes in and, comes with policies when the time arises, and I expect him to continue doing that as things change as we go on. But very, very surprising, and then we'll see how things develop over time.
I'm not sure if we have Abdulrahman on the phone now, but Abdulrahman, if you can hear me, what's your reaction to the decision today?
Yes, I'm back on.
All right, I wanted to get your reaction to the decision. A surprise move, no change in the MPR or any of the other parameters.
Yes, I think for a banker, I would say that is quite disappointing. I hear, Rewane, that maybe you don't want to do signal that may be misread and all that. But that is your job as a central bank. That is the job of the MPC to clarify whatever they are trying to signal, and also trust that as rational economic beings, people are going to take a cue from that. I mean, give, for example, you talked at the beginning about the need for the banks to support what is being done and use moral suasion. But why don't you give them some signal? For example, the increase in cash reserve requirement that was taken to 27.5 just before this crisis happened should be reversed. I mean, at the beginning, just to show that, yes, we wanted to go this direction before COVID-19 has come, and that cannot hold. Then take it back. Or even go all the way down to 20% for cash reserve requirement. Let's have liquidity in the system so that people will be able to, the banks will be able to have room to move around, to navigate, and be able to, drop rates along the way. All the talk that if you drop MPR, it does not change the lending rate downwards is neither here nor there. But if you change liquidity, it will definitely affect the rate down the line. But more importantly for me, I think the concern may be too much on the exchange rate protection. Maybe for that reason, there is a lot of concern that, okay, if you give a bit of more money to the banks, it will go chasing FX instead of supporting manufacturing and all of that. For me, we do know clearly that we do not have the latent productive capacity in the system. And that is what we are supposed to spend all of this time trying to address. So that when you release liquidity, you can then use it to increase output of goods and services.
Okay, I wanted to actually ask that question. What would the banks use the increased liquidity for at this time? If we're not seeing a significant the market conditions doesn't suggest that they can increase, businesses in general can increase production significantly. The consumers clearly are going to be sitting at home, so that growth is not likely to be there.
So the first thing you should understand in balance sheet management in banks is that there is cost of funds, and then there is lending rate. And the idea is to keep that at a healthy margin. If cash reserve requirement is so high, that has already contributed so much to the cost of funds. So the floor, you have just increased the floor to a level that even if a bank wants to reduce lending, it cannot be at a loss.
Right. So it's a cost of.
The first thing is, why don't you just reduce the cost push part of this rate to a level where at least it can be reasonable. I mean, other economies in the US, the rate is now 0. Right. In the UK, it's now 0.1. And here I'm sitting here hearing that we are doing nothing.
All right. Let me hear from Charles. Charles, very unusual signal by the Monetary Policy Committee there. And I think if we can just take it from the point that Abdulrahman just made, pretty much every central bank across the world has signaled with a rate cut. But Nigeria, obviously, contrarian here.
Well, I think it's an interesting move, and it explains why we were thinking they might hike 100 basis points last week and then maybe cut 50 basis points this week. So, we've also been uncertain. What Pakistan has just done a couple of minutes ago is a second rate cut this week, another 150 basis points. But Pakistan is an oil importer. They're going to see inflation fall as a result of the fall in the oil prices. You take a country like Kazakhstan that I mentioned earlier in the program. They raised interest rates 275 basis points because their currency's weakened off because they export oil. And I think what the central bank is doing is taking a cautious stance that actually I think foreign investors will be quite interested by as well. They're saying we're not going to take big risks with inflation. An interest rate cut at this time is probably less important in terms of stimulating the economy than what I mentioned earlier in the program. It's letting the currency weaken. That's the really helpful thing for Nigeria's budget. It's the good news, I think, for Nigeria's current account. So the interest rate cut, we were looking this week, we were discussing whether they might cut 50. But I think this is just saying we're going to wait and see. Let's give it another month. They can always cut rates again next week. And the difference between Nigeria and the rest of Western Europe and the States is that, as Bismarck said, inflation is 13%, or heading that way. We think it's going to get to the mid-teens. There is no inflation in Europe and the States. There's a deflation risk. Central banks can't cut rates enough very easily. So I think Nigeria is in a different position. In terms of real interest rates, they're already negative probably in Nigeria right now.
Interesting point there. Do you want to react to some of the points Charles
was saying? What we are not seeing is the fact that we have, apart from anything else, we have a fiscal imbalance. The oil revenues of Nigeria are dropping by about 50 or 60% compared to where they were last quarter. That fiscal gap has to be funded by issuing federal government paper. This federal government paper, bonds, treasury bills, have to be put in the market. If you put that much in the market and you want it funded and you're not going to cover it by ways and means of the central bank, then rates have to go up. So that allows you to do that. For liquidity management, the fact that you've amended or adjusted the exchange rate, you are taking more naira for every dollar you're giving out. So you can use the exchange rate as a tool for, one, managing the reserves, and two, for managing liquidity in the banking system. Right. But you still have to fund the shortfall. The fiscal deficit is projected to go as high as maybe 4.53 trillion from around 2 trillion. That extra money, together with the securitization of federal government debt, right, will have to be put in the market. You are not going to put those things in the market at 2.5% or 3.5%, which is where the Nigerian treasury bills are trading. You are going to have a single yield curve, both for the OMOs and the Nigerian treasury bills. When you do that, automatically, those interest rates will go up. But in terms of sending signals to the market for economic agents, you can send the signal that, yeah, we are in stimulus mode, we are doing this and that, and then that is it. But I didn't expect that the signaling of the MPR was going to be a tool for economic management. The real tool for economic management is how to deal with the fiscal balance, deal with the balance of trade negative, which you're going to have, the current account deficit, which you have, and finally, in terms of contraction of growth.
Right. Lanre, I want you to speak on the point that he just made, which is the difference between the OMO rates, which we know is more or less an exclusive club for the foreign investors, and of course the rest of the government securities market. Do you think that, given all that has transpired over the last few weeks, that there's still a case for us to have that segmentation of the market? Is there any incentive, or is it serving any purpose right now?
So will he open up that club to the public? Is yet to be seen. So the last OMO auction that happened, 0 bids. So a lot of internationals are exited, right? And also the rates that we're coming at, I mean, the same OMO instrument in the secondary market is going for about 17, 18%. They came to market with the usual 12, 13%. So is he going to open it up? Unlikely, because he's been quite adamant about what he wants to do with that particular instrument.
My point is that, is it serving any purpose? Because you just mentioned there was 0 bids at the last...
The purpose was that he felt the local investors, some of the monies in local should be channeled into, their economy here locally.
I hear you.
To me, I I can't really call if it's serving its purpose right now, and we haven't seen the data.
I get the sense that the foreign investors are, if I can use the phrase, they've left. They're just not. They're not interested right now, given what's happening globally.
And that's more driven by the fact that they came here with dollars. They want to be able to leave with their dollars. There's concern about a lot of liquidity in the system. Right. And back to the currency, to the exchange rate. Our view, I still think the what the forward dollar is looking at is around 400 to 420 naira. So I think there might even still be some room, and that might be a tool he might end up coming with down the road and further, adjust, right. Not use the word value.
Manage liquidity.
Liquidity.
If I can quickly get a thought on this from Abdulrahman, and that's the health of the banking sector. Now, the central bank governor, in his broadcast did mention that they're very happy with the health of the sector right now. But we know what shocks like this have meant for the banking sector in the past, 2008, 2009, and indeed, to a lesser extent, 2015, 2016. Are you concerned, given the adjustment we're seeing in the currency and, of course, the movement in the oil price in terms of the health of the banking sector right now?
Yes, I think the address of the governor has addressed the big concern, which is issue of time frame. He has given a 1-year moratorium, and therefore we believe this crisis hopefully will not last no more than a few months from here, and therefore people will be able to get back to business, repackage whatever needed to be.
But what about the exposure to the oil sector?
All that. Well, the oil sector exposure has happened before, and if it repeats again, the same mechanism is already in place to make sure that you are able to rearrange the liquidity. You see, any facility you give, as long as you have the liberty to rearrange its repayment structure and it has its fundamental underlying cash flow that can repay it, it's a matter of time. I mean, there is a war going on currently between OPEC, Saudi Arabia, Russia, and all of that. Down the line, that will be resolved one way or the other. Oil price will get back to its normal 40, 50 range, and that will do. But you need that 1 year, 18 months moratorium to make sure you're able to address all of those things. But I wouldn't want to drop without taking you back to BJ Rewane's position that there is fiscal imbalance, and the monetary policy is trying to see what they can do to correct it. In an ideal world, it has to be a hand-in-glove arrangement. You cannot be throwing monetary policy tools at all our problems. We kept importing oil, and if that is the biggest item on the import bill of Nigeria, and as of today, oil price is now down to $25 per barrel, how come we are not using this opportunity to get out of the subsidy mess? Somebody should deal with that, and we should bring it to play. For me, if you address the demand side, and that figure from the oil import side, probably half of our total imports, right, then you have done a good job of putting yourself in a position where your reserves can take you further than what it is now.
Right. Okay, Charles, I'm going to give you the final word. And speaking beyond monetary policy right now, I mean, when you take a look at Nigeria right now, I am sure you're concerned about the health risks, but is that your greatest concern, looking at what is likely to transpire over the next few months?
From the perspective of foreign investors, the most important factor is probably just the central bank keeping dollar liquidity available, that they allow the exchange rate to be at a place where roughly demand and supply of foreign exchange is matched. And if they can do that, if we don't go back to the 2015-2016 period of FX shortages, then foreign investors can stay involved in Nigeria. What Nigeria lost was in 15-16 was all foreign investment because of those FX shortages. And I don't want to see that happen again. I want to see people putting money back into Nigeria and helping the economy grow. So it's the most important. They keep supplying the liquidity at the right exchange rate. And that, I think, will help offset some of the other pain.
All right. Well, Charles, thank you so much for your insight. We have to wrap it up there.